Alright, hello out there. This is DayTraderRockStar for actually just do an educational video here on the E-minis. This is being actually recorded here tonight, October 20, I think it's 23rd, 24th. But the market's been in a major beat down here. I'm watching the overnight futures now. Right now, they're actually starting to move up. It might make for an interesting day tomorrow, but we're not really going to talk about the overall markets. What we want to talk about is how to trade them and the benefits of trading the futures, the E-mini futures, the ES in particular. One of the great benefits there for a lot of people who don't have a lot of money to invest, the futures don't fall under the pattern day trader rule, where you're forced to only make a certain limited number of trades per week or in a time period. So futures you could trade in and out. Also, there's always a market here. It's actually a very good technical vehicle to use to make some money. And I'm going to actually go over my style that I use when I trade the ES futures on my site. Now I have a radio show and a stock market live broadcast, a screencast, also showing live trading at www.daytradingradio.com. So you get to listen to live trading, live news, live alerts. And there's actually a great trading room there. It's open to the public, and it's just come on by. But again, I just want to open up what I do out there in the markets and where I see some things. So I work off of a what's called a 5-indicator system. A little system I developed. And again, I'm always cautious people using the word system, as that kind of pigeonholes you in a type, and that's not good to do, as you all know. But just to put some boundaries on this video, it's kind of a system that I developed to keep me out of the choppy trades, to be able to focus and kind of narrow down the best possible trade of the day. Now, you don't have to trade the E-minis in and out. Some people trade it for scalp a point here, scalp a point here, to there. What I'm looking for is a decent move, 4 or 5 points, and take about 2 or 3, maybe 4 trades a day like that. But that takes me out a lot of the chop. So I want to go into how I determine how to get into my positions and where sometimes I determine where to get out. All right. Well, the first thing I look at here is actually the bias going into the day, and I try to determine just by being in the markets each day, and that's an important factor, is that you need to be in the markets each day to be a successful trader. I mean, you can come and go, trade a few, part-time trader, but to really feel the the soul and the motion of the markets, you really need to be, invested, and not invested, but, part of it. Feel the pulse of the market each day. So in the morning, I try to determine what the overall sentiment is, for the day coming up, and to see if we're going to have a bullish day or the bias is to the bearish side. And from there, I just kind of determine how I'm going to set up my trades. Overall, I would say I'm a pretty bullish person, so hopefully I like to trade to the upside. But futures, easily you could trade to the downside also. So, that's an easier trade there. So what I first look at is the stochastics here, and this is the stochastics, a set of indicators, and that's my number one indicator that I use. Now I could go into a lot about stochastics, but this is a video pretty much that's going to encompass a lot of different indicators. So I'm going to leave it up to you to do your own research. But there is some good information out there. I'll tell you my indicators and my parameters for these indicators. I use, in this case, this is the full stochastic indicator. You have a slow stochastic, you have a fast stochastic, and you have a full stochastic. And the benefits of the full, it's kind of a little smooth, a little smoother, and it's not that choppy and stuff. I also like to use the slow stochastics also. And that's the first thing I want to watch. And again, this is going to be a long video. Probably break this video down into a few different parts so I can just cover everything and get everything there. But there's a couple issues that need to be addressed with the stochastics. A signal is usually given when the stochastics get into an overbought or an oversold level. I mean, if they get up to the peaks above 80 and below 20, that would be the levels you would be looking for. But there's also other kinds of symbols and setups and that we need to watch out for. So we'll try to go. And again, this will be a basic guide here on trading the futures. So The stochastic is my first indicator. Then I also like to back that up with the moving averages. The 20-period moving average, the EMA, exponential moving average on the 5-minute chart of the S&P index is the chart I usually use on this. All right, so and as you can see, here's a good example on the chart we're looking at here. This is what your stochastics will look like. This is what your moving averages will look like, and this is your price on a candlestick bar. And the parameters on my stochastics are 14, 3, and 3. 3 being the middle 3 being the smoothing factor. Normally you would just have two parameters there for the slow or for the fast. So I advise just try either the slow or the fast to see which works best for you. Some people think that the slow might be a little choppy or a little whippy. The fast is kind of smoothed over and it's not as choppy. Let's see what else we got. Oh, another thing about the embedded stochastics. This is another a term that you should learn is the embedded stochastics. When a stochastic indicator gets up above the 80 or tries to really get high above 90 or down below 10 and holds there for 3 trading periods. Say 3 trading periods could be any if you're trading a 5-minute bar, it would be 3 5-minute bars, a 15-minute period, or if you're trading an hour chart or a daily chart, it would be 3 of those periods. And when it holds up into that level, it's called embedded. And it usually means that there's underlying pressure in the market going in that direction. If it was bullish or bearish, you could look for a continued pop, and usually a more aggressive move up further from that. We'll just say up for now. So again, I try to look for the embedded stochastics and also line those up. And I'm going to show you how to do that now. All right. Let's see, what can we break this down into? All right, again, the 20-period moving average is the first moving average I like to use. All right. You can see this chart here that I have up. Actually, these green arrows are actually marking each of the times that the price level came down and touched the 20-period moving average and actually bounced off of it. Either to the a downside support and then it bounced, or we came up from underneath and we hit it as resistance and bounced down. So you can just see the different levels that we've used the 20-period moving average off of. So that's very important to see that and see how important that is to hold on to that 20-period moving average. All right, this first setup it's called just a regular basic long. Here's a very basic long setup that sometimes I look for in the market. It's one of the most basic setups here. Again, trading to the upside. I look for the, usually in an uptrending market, the price level is going to be above the 20-period moving average. We get a little extended from there, either a pop up above the 50 or the 20 and gets a little extended, and then the price level drifts back. Or any other situation where the price level is still trading above the 20-period moving average and the stochastics come back down into an oversold level. So I look for oversold stochastics with the price level above the 20 period pulling back but holding above the 20-period moving level. And I look for a bounce off of that. That's usually 2 good setups, using 2 indicators, getting a setup for a move higher here. Just looking at some examples where we really got a nice pullback, but we held on to these moving averages. And not every case it's going to pull back below the 20 area or even the 30 area, because in some really bullish markets, this underlying pressure, it's more of an embedded stochastics that doesn't pull back that much. So, but this is usually a good setup if you could find it. It's something to watch. That's the first example. The next example, the second setup here is with the embedded stochastics and a slight pullback, also on a bullish uptrend. When you have the stochastics embedded for 3 of the time periods, and look for a slight pullback, even if not even a pullback, but just a slight pullback, holding above the 20-period moving average, and then just look for some good strength coming in right after that. Anytime you see that embedded stochastics and a slight little pullback that holds above the 20-period moving average, but again, this is a combination of the embedded stochastics. In these other cases, we actually pulled off of here. But this is one of the best setups out there, so definitely watch out for that. At this point, this would probably be I'm going to close this video down because YouTube only allows me 10 minutes, and I'm going to finish up the other 2 and I'll send them out soon. So this is the end of the first video. part 1. I got 2 more videos going to get released here, and they'll be posted on the site at www.daytradingradio.com.